Welcome to Investors Guide. Thank you so much for tuning in. Go grab a pen and paper. I'll give you a second. You can write down all of the advice you hear on the show. You can also write down my email ID and you can write down the Twitter handle where you can reach me personally. On the show this week, we'll tell you if you should continue investing in ULIPs at all, or is that a product that was 2 years ago. In our product review, we look at the IDFC Premier Equity Fund, should you stay invested, and first-time investors. We'll tell you how to get started from scratch. First, let me bring in Kumar, the CEO of Value Research. Thank you so much for coming in.
Thank you.
And we've started having these conversations in the beginning of the show where we put into focus the big news of the week or any sort of development that affects our money. Now, there was a lot of talk, obviously, about the Fed, which is America's RBI, and their decision on their interest rates. Now, the Fed decided after much anticipation across the world not to do anything and to exactly hold the rates where they were. Now, there was a reaction, of course, in our stock market. It would suffice to say that we saw a volatile reaction. It was up one day, it was down the next. I want to understand from you, for an average investor in India, do events like this matter? Will there be any sort of long-term impact on my investment from what the Fed has decided? Because now we're just waiting again for another few months to see whether or not the Fed brings down, increases the rate the next time around. What's your advice? Should we pay attention to events like this?
Generally speaking, these events have no material impact on your long-term savings. But it is extremely difficult to, ignore such an event because when such an event happens, last time round when the erstwhile, the Fed chief said one particular word in his speech, which was tapering. The markets globally, were completely shaken. And after that, I think the Fed has also been very conscious of, the words and expressions being visible or talked about. So, the world is, the world markets are far more connected. They are actually, waiting to react. And I think, in the long term, it doesn't affect investors. But in the short run, it is extremely difficult to ignore such an event, because once you see that one such event and the behavior of other market participant has such an impact, last time the tapering word was expressed, what we saw was our liquid funds went down in value for a day, which was completely, which was completely unexpected. It was unheard of and unprecedented. We have never had such an impact. So I would say that it is hard to ignore. But if you are a long-term investor doing your SIP, choosing good funds and good businesses to invest in, and following the basic tenets, I don't think one should worry. And ignoring this noise is extremely important. And maybe, it's hard to ignore, but it is worthwhile ignoring it. Maybe it creates an opportunity for some people. But even don't think in terms of capitalizing on an opportunity, because the moment you try and think in terms of capitalizing on an opportunity created by such a panic or sometime exuberance, then it amounts to timing and it derails you from a long-term plan.
So remember to stay focused on your portfolio, focused on the investments that you have. And while it's interesting to sort of be informed about what's happening in the rest of the world, it doesn't have a direct impact on your money, which means you don't need to panic as much. And also, like we keep saying on the show, you don't need to be looking for opportunities in a market. As long as you have an SIP running on a regular basis, you have very little to worry about. Dhirendra, the next question is going to really, really impress you. This one has come in from a 22-year-old, and you should see his portfolio. It is so impressive. Paramjeet Patnaik has written in from West Bengal. This is a 22-year-old with a target of building a 1 crore rupee corpus in the next 10 years. And look at his portfolio, Dhirendra. He has mutual funds of 10,000 rupees a month, which he's been investing in for over a year. He has 500 rupees a month going into the PPF. He has 3,000 rupees a quarter in the NPS, $1.5 lakh in stocks, health insurance that he's getting right now. And he wants to know if he should be buying life insurance. He sent us a list of the funds that he invests in as well. We're going to get to that in a bit. But I'm, while there will be some tweaking required in his portfolio, I'm just so impressed with a 22-year-old who has a portfolio that is this comprehensive. Can we all learn from someone who starts that young?
Yes, he's quite a lesson. And more importantly, he has not committed mistakes, because most of the time investors learn from their mistakes. So generally a 22-year-old would have bought some endowment policy, some traditional policy, or it will be completely into PPF. So that generally requires a bit of undoing. I don't think there is, minor tweaks, or, we can actually try and not persuade him, but, we can share our perspective in terms of how to approach it little more, logically. But that's our viewpoint. Otherwise, it all seems very nicely in place.
It all seems nicely in place. In fact, let's quickly go over those, those funds as well. SBI Emerging Business, Reliance Equity Opportunities, Reliance Tax Saver, HDFC Balanced, HDFC Mid Cap Opportunities, Quantum Long-Term Equity, Quantum Tax Saving, Reliance Retirement. Dhirendra, I'm not very sure about Reliance Retirement, but the rest of it seems to be fairly well chosen. Again, is there any need for tweaking, or you think he's on the right track?
Yeah, I'm a little unsure about the retirement plan as well as, the HDFC Balance Fund. But also I don't see a need for, small amount of money going into too many funds, because not for any other reason. He has chosen good funds, and most of these funds, if one is investing in a disciplined way, it will prove worthwhile, or it will be, reasonably rewarding. But the point is that, he'll be more interested if he has few funds, and that will achieve him the same objective. Having his 500 rupee going into 9 funds is not getting him any special advantage. Maybe, if it's going into 4 funds, he'll be more interested in tracking them, keeping change of, making changes as and when needed, because he will have some meaningful stake in those funds.
All right, so that's the advice you're getting right now. And remember, Dhirendra said you're pretty on track, and you're only 22, and that makes us really happy. What I would like you to do is, of course, get a life insurance policy, get a pure term policy. And the reason why I want you to do it now is because at your age, it will be so easy to buy. It'll be so affordable. It'll be so hassle-free. So you can get started and get that policy. And since you are planning marriage and children and a future going ahead, it always helps to, buy that policy earlier and get started right now. Dhirendra, we have another question from a very young man. 26-year-old Harish Kumar has written in. He tells us he's in the 20% tax slab. He currently has a ULIP running for 60,000 rupees a year. He now would like to invest the surplus 80,000 rupees a year to save on tax. And he has very specific goals. He wants some of it to go towards the long term of 15 and 20 years. He wants some of it for short term of 5 and 7 years, and some to go into his emergency fund. Now, I don't know if there's a tax saving option for his emergency fund other than perhaps a 5-year fixed deposit, but then we wouldn't want him to break that at a moment's notice. But if we focus on the long and short-term goals, in terms of saving on tax, what would you like him to invest in?
No, one is that emergency fund is ruled out, because, there is one important thing to note about even the fixed deposit, the 5-year deposit which you make for tax saving. Those deposits are not eligible for as a pledge. You can't, give that as a collateral and borrow against that, which you normally can against any fixed deposit. So that is a reasonably illiquid fixed deposit, so to say. Then comes, any other tax saving option. The only thing which comes to my mind, whether it be 5 to 7 years or, even 10 years and, 15, 20 years, he should seriously consider, his allocation going to a tax saving fund, and he will be able to avail the tax break. And he should have discontinued the ULIP anyway before, as it, it's about to expire now. So all that money which he'll be saving, which was going as his premium for ULIP, should find its way into the tax saving fund.
All right, so discontinue the ULIP, use that money to invest in a tax saving fund. On your screen right now, 2 sets of tax saving funds, one of which is conservative, the other one is aggressive. So you can use the aggressive set for your long-term goals and the conservative set for your short-term goals. Also, someone from my team will get in touch with you and email that list to you as well. Welcome back. You're watching Investors Guide in ET now. It's time for our product review. Now, we got a question from Sandeep Arora, and the reason why we're bringing this up, Dhirendra, is because we got a lot of similar questions, which is why we've decided to review this particular fund. Now, Sandeep is invested in the IDFC Premier Equity Plan, and he tells us that he's not, he's not very happy with the performance, and he wants to know if he should now be replacing this fund with the Birla Sun Life MNC fund. He's been investing 5,000 rupees in this fund for a couple of years, from what we understand. and he wants to know what to do. So before we actually get into the details, I am going to bring in Avan, who will give us an update of the performance of IDFC Premier Equity in the last 1 year. So we'll see what Sandeep Arora's concern really is with the numbers, and then we can come back and tell him what he should be doing.
Thanks, Faye. The fund in focus this week is the IDFC Premier Equity Fund. With a return of 21% since its launch in 2005, this fund has had a good long-term track record. But how does its performance look in the recent past? Let's take a look at its performance chart over the last 5 years. The red line is the fund and the blue line is the benchmark, the BSE 500. You'll see that the fund has performed better than its benchmark consistently over the long term, with an ability to restrict its fall against its peers in a market downturn. However, you'll also notice that the fund has not been able to fare better than its category in a rising market. While the fund outperformed its category with a return of 6% in the year 2013, it underperformed the following year with a return of 59%. The fund's trailing returns clearly indicate that it has performed better than its benchmark and category in the 5 and 7 year periods. In the recent past, however, it's not been the best in its category. Should the fund's recent performance be a cause of worry if you're a long-term investor? Let's find out. With that, it's back to you, Faye.
Right, Avan, thank you for those numbers. Dhirendra, if we look at the performance, like Avan was telling us, on value research, it's come down to 3 stars. Where would you rate this fund? For investors like Sandeep who are looking at it saying, maybe it's not so great, it hasn't done as well. Would you say, given the larger market performance, this is actually not, not disappointing?
No, it is not only not disappointing, it's an outstanding fund. This is actually a problem with our methodology a little bit, because we have clubbed this and which is a problem which we are going to fix in the coming month. At Value Research we have a category of mid and small cap funds. This category was created when we didn't have too many small cap funds, and now we have reasonable number of small cap fund and we have reasonable number of mid cap funds. This category needs segregation, because what has happened is right now the small caps and the micro caps completely dominate this category, and compared to that, some of these funds which are actually multi caps, a good part in mid caps, not much in small caps, and little bit in large caps. These funds which are getting clubbed into this category, they look bad in comparison to the overall, and there are about 100 funds here, so this needs a segregation. Looking at IDFC Premier Equity in isolation, I think it's an outstanding fund. Last 10 years, it has beaten its benchmark consistently. Of course, beating the benchmark does not mean that it was an outstanding fund. It was able to protect you from big declines. Yes, in 2008 it fell. But if we look at consistency of performance or thought driven, which has been guiding this fund, I think those variables have played out very nicely. There has been a key event in the life of this fund last month, which was the fund managers left, and I would say that the fund was managed by him since its start. So that's a big change. We have to be a little watchful. But going by what this fund has been able to do, what it has been able to institute in itself, the way it constructs its portfolio, the kind of stocks it never buys, I think if that is reasonably in place, then one is very, there is every reason why one should be very happy and pleased with this fund.
In fact, Dhirendra, the other piece of advice that we must seek at this point, if we look at the 3-year return of the funds in this category, it's close to 25% annualized. Now, if we compare that to this year, where the average return is between 11, 13, 15%, it is possible that an investor who's been getting stellar returns over the last 3-4 years is looking at his fund saying, is my fund underperforming, without realizing that the larger market is possibly going through a really bad phase. So how should we compare and understand the performance of our funds for this year?
No, one is that one should look at it a little differently. This fund falls into our mid and small cap category, but it is not a mid and small cap fund by design. And where a large number of funds in this category are focused on investing in small and mid caps only, and they have had a good time in last 1.5 years. If you look at some of the best performing funds in this category, they will be up about 50-70% even now, despite the decline. So I don't think it's the right comparison. Then looking at what this fund does in its stock selection, the way it has gone about demonstrating it over time, the belief system it carries, I think on that count, this fund has been way too impressive. It does not get distracted from what it has set out to do, and that turns out to be really a great anchor immediately after bad times.
All right, Dhirendra, finally, give us your verdict on the IDFC Premier Equity Plan. How many stars would you place it at?
Going by that, it has slipped on performance relatively. I would still call it, a notch above our risk-adjusted rating, which is 3-star. I will call it a 4-star fund.
4 stars there for the IDFC Premier Equity Plan. And remember, Dhirendra said there's no need to panic if you're an investor in this fund right now. Its performance relative to the market has not been disappointing for this year. And we watch it on this show. We watch all of these funds very, very closely. So if there's any movement that is necessary, you'll hear it first from us. So that rating is on your screen right now. If you have any other questions about funds you're holding, feel free to get in touch. It'll be our pleasure to help you out. Dhirendra, before I let you go, 28-year-old Robin Kumar has written in. He wants to invest at least 25,000 rupees a month in mutual funds and save tax. And he wants to buy a term plan and invest in the PPF. So he sent in all of his requests. How should he plan his investments, Dhirendra? I would like him to start with the term plan. But for a young man looking to put money in tax-saving instruments, can he skip the PPF and do only ELSS?
Yes, I would encourage him to. And he should, in fact, and just to compare, I think he should continue with a 500 rupee PPF so that he can see how his money has grown. India is largely a fixed income country. We have such deep-rooted belief in fixed income, and that is something which we have inherited from our parents as well. And we don't come across too many investors who have invested in equity regularly, methodically over a long period of time. So I would suggest that he should have 500 rupee in PPF just in case he has to, and he should do all the money on which he can avail the tax advantage, get the tax break, should find its way into a tax saving fund. He should do it for 3-4 years and see for himself what it translates into.
All right, so tax savers are on your screen right now, and since you're a young man, we'd like you to invest in these tax savers and stay invested for the long term. You're willing to put money in the PPF, that's a 15-year lock-in. Well, stay in your tax savers for 15 years as well, and like Dhirendra said, put 500 rupees in your PPF. So, out of the 25,000 rupees you have to spare, 24.5 goes into your tax savers, your ELSS, 500 rupees goes into PPF, just to prove to yourself that you've made the right decision. Dhirendra, thank you so much for joining us on the show. If you have a question for Dhirendra Kumar, email ID is at the bottom of your screen. Watching Investors Guide on ET now. Thank you for staying with us. This week, we're going to answer questions on asset allocations. Feroz joins us now from the Anand Rathi Wealth Management. Feroz, thanks so much for joining us. Our first question comes in from Sumit, who's planning to invest 10,000 rupees a month in mutual funds. He wants to know what his investment strategy should be.
Since you're a first-time investor, it's very good decision that you're actually using mutual funds as a vehicle to invest in the equity markets and participate in the growth of the country, rather than actually going into direct stocks, which can actually be quite a tricky thing for a first timer. So equity mutual funds is the way to go, and the category of funds also, because you're a beginner, should be the conventional funds, which are the large cap funds and the mid cap funds. In the large cap category, you can definitely look at a fund like a Mirai India Asset Opportunities Fund, and the mid cap category you can look at HDFC Mid Cap, both managed very well. The sector and stock selections, both by both the fund managers, Gopal and Chirag, has been exceptionally good. I think that will really help you achieve your objective of starting out investments. But one point which I would definitely like to make is put some emphasis on the goals and do some introspection in terms of what are you saving for, so that there's some degree of emotional attachment to the saving, and so that consistent investments become more of a probability if you actually know what the end use of the money you're collecting is.
Jitin Sharma has written in. Now, he's looking to build a corpus for his daughter. He has about 15 to 20 years in which he can do that. He has 1,000 rupees going into the Birla Sun Life Frontline Equity and another 1,000 going into the Birla MNC Fund. And here's the thing, 15,000 rupees a month going into an RD. He wants to know if he's on the right track. I'll tell you what, Jitin, you're not on the right track. You're completely off the right track at this point. You should be doing the exact opposite and not investing so much money in an RD. Feroz, could you help him sort out his asset allocation, please?
Jitin, the asset allocation which you're following, in the sense how much money you're putting in debt and how much you're putting in equity, is very strongly skewed towards debt, because you have a 15,000 rupee RD in per month, and that's and just about a couple of thousand rupees in equity. I think this will certainly not help you meet your long-term objectives of getting your daughter educated and married in turn. So I think actually turning your asset allocation over its head and putting 15-20% in debt and 80% in equity, which I think is a wise asset allocation to do, because equities over long terms have a tendency to outbeat debt by a handsome margin, and that's the only asset class in the financial space which can actually beat inflation over long periods of time. So very importantly, change your asset allocation from 12% in equity, which you currently do have, to almost about 80%, and then have 20% in debt. So that will actually increase the probability of getting your goals met. And in the funds category, I think you can look at two funds, which is in the large cap category. You can look at an SBI Magnum Blue Chip Fund, and in the debt category, you can look at Kotak Income Opportunities Fund. In the equity category, you will need 2-3 funds, because you're exposing 80% of your money. So in the mid cap space, look at an HDFC mid cap fund, which is a very good mid cap fund. One large cap fund, one mid cap fund, and one debt fund. I think that's better, and not more than 20% of your total disposable income on a monthly basis should be going into debt. And RDs are going to be more tax inefficient, so a debt fund over 3 years plus will actually be a tax arbitrage, and you will get better tax efficiency. So I would suggest you stop an RD and be in a fund which actually gets the capital gain benefit and also the indexation benefit, which an RD doesn't get.
Last question on the show comes in from Jero. I hope I said that right. He has a lump sum of 3 lakh rupees. He'd like to invest it over the next 3 to 5 years, and he wants to know if it's advisable to put in the lump sum and what mutual fund should he be looking at. First of all, if you are investing in mutual funds, Jero, don't do only 3 or 5 years. Try and see if you can stay invested for 10 or 15. That's the first job. If you can't stay invested at all, nevertheless, avoid the lump sum. Feroz, can you help him out with that investment, please?
Jero, I think it's definitely a good opportune time to actually do a lump sum investment as well, as long as you have the stomach to take the risk. And in that category, in the equity category, having 3 funds will automatically bring down the risk, because that will inherently bring almost about 100 to 140 stocks in your portfolio. So in the large cap category, I'll recommend you 2 funds, which is Birla Frontline Equity Fund and SBI Magnum Blue Chip Fund. These are the 2 large ones, and the mid cap fund would be a Religare Invesco Mid and Small Cap Fund.
All right, that's a wrap on Investor's Guide. Feroz, thank you so much for answering those questions. If you have a question about anything to do with your money, you know you can get in touch with us. We're right here. We've been here for the last 7 years. All you have to do, write to us, email ID, get in touch on Facebook, and tune in next week to catch the show. Thanks for watching.